Last week, I shared with you this chart on the screen. We talked about gold prices. We talked about GLD. We talked about first quarter projected ranges, and I had some projected ranges that just looked really hard to fathom. But then we all saw what happened with gold and silver over the last couple weeks. They had some major drops in some very, very short time frames. Well, I'm back to talk about this again because not only did I mention in our last video together that I felt that out of these two, looking at gold and silver, that gold was going to be the stronger of the two. Well, it gets better because guess what? I'm back to being bullish on gold again as a trader. As a trader, based on what's happened in the last few months, gold should outperform silver, right? Now, both of these have suffered some major drops in the last 2 weeks. And I want to talk about why I think it's time to look at gold once again. All right. So here we go. Gold. Now, before I go looking at a chart, I want to show you a couple things that the money calendar is showing me right now when we're looking at gold and silver. Gold right now is, as of today, is now saying, hey, guess what? We now have a seasonal buying opportunity in the metal. It wasn't here last week. It wasn't here the week before. Everything we were looking at prior to today was chart only. There was nothing that leaned into either the bullish or bearish side. But what we are seeing is, as of today, not only gold, but gold indexes and gold miners are now popping on the screen as potential buying opportunities. Take a look at the three here. I've got GLD, I've got GDX, and I've got IAU, all in the gold industry. So moving forward, let's take a look at GDX because GDX is a gold miner. And the GDX gold miners, they tend to, in a lot of cases, they tend to lag slightly on what happens with the pattern in gold. Here's a 47-day trade, 90% accuracy. All right. Last time this pattern did not work, you got to go back to 2017. All right. Between now and the middle of April 16th. If you look at every other pattern on here, you could see 2016, this thing had a 25% move between now and mid-April. 2018, 3.68% move. Barely anything in 2019, but a win's a win, even if it's just a fraction. Take a look at that 5.5% gain in 2020, 1.69% gain in 2021. Big 30% move in 2022, which was interesting because we all know what happened in 2022. We saw a move to the downside, right? You've got a pattern in 2023 that was positive, 2024 and 2025 over 20%. Where do we go from here? All right. Take a look at GDX on the daily chart. You can see here a projected price of $110, projected time of 4/16. That's April 16th, 2026. My bad. The implied volatility, though, is a bit high. And what I'm talking about is option premium. Option premium last summer was trading around the 30 percentile mark as compared to option premium at the top of February was trading near 60. What do these percentiles mean, Tom? Well, they mean this. If you were looking at, let's say, a 30 or 60 or 90-day option back in July of last year, and you were looking at the at-the-money options versus the at-the-money options in February, you're going to see that there is almost twice the amount of time premium on these options, twice the amount of time premium. Therefore, what we also see is we see twice the amount of option price. So when I look at this, I can look at trading calls. Hey, you know what? GDX, I can buy the stock. I could buy the call options. I mean, I could buy them for a set price, set amount of time. There's no obligation. But as a buyer, I'm paying premium for these. So what can I do if the options I'm buying are simply too expensive, like they look like they are in the chart that I just showed you? Well, we could look at spreading. I talk about spreading a lot in this program. Why do I do that? Because options are not cheap right now, like they are with WEC. Options are expensive in gold and gold stocks, and options on gold stocks and ETFs. So this is something we have to keep in consideration. In this case, I would rather spread my risk, buy the lower strike, sell the higher strike, and do it for an area where we can at least cut the cost and cut the risk on the trade. And that's what we look at doing. So here's a chart of GDX coming into the morning. And what you're seeing here is you're seeing volume, you're seeing open interest on these April 17th call options, you're seeing an options delta, you're seeing the bid and the offer, and over here on the side, on the right side, the strike price. For instance, I was looking at this at $100. If I wanted the right to buy GDX at 100, where's GDX at right now? Trading around 97 as of the close of Friday. So $100 that you're looking at paying somewhere between $710 and $760 for those options. You know, it's one thing to spot the opportunity, but we've got to create that trade, that alternative risk trade that you and I want, that we're able to accept. And so as I look at this, I'm thinking, well, wow, if I'm looking for a move, you know, a move on GDX where I see it going to where? 110. If I'm going to pay $7 and let's call it $7.50. I'm going to pay $7.50 for something that could get to 110 that could be only worth 10, then I'm risking $7.50 to make $2.50. If you like that, if that's what you want to do, far be it for me to tell you what to do. But I think there's a better way. The better way is this. Rather than risk 75% to make 25%, how about coming in and selling something? And now I could take my risk from $7.50. What if I cut that in half? What if all of a sudden now that becomes a $3.25 risk by selling something like, for instance, the 110 calls? You could sell any of these. You know, they would be considered a higher strike call. Buy the lower, sell the higher. But if I went all the way out and looked at the 110 and I bought the 100 and sold the 110, if I paid $3.25 for it, for instance, what am I doing? Well, I am setting myself up to now pay $325 for something that was going to cost me $750. I've cut the cost in half. I've cut the risk in half. And now I've also cut a lot of the day-to-day fluctuations that gold and GDX might do to me. Cut those in half too. All right. So for gold miners, for gold and gold miners alike, the seasonal pattern has just begun. Right? Implied volatility is near its one-year highs on gold ETFs, and things like GDX, the miners. So selling premium or spreading your option premium, for instance, with a call spread, as we just showed you, is one of the best ways to mitigate risk and maximize your return potential, right? What do you guys think? What do you like about gold? What do you like about GDX? Does this make sense to you? Or perhaps are you going to sit this one out in terms of what you see happening in the world of gold, silver, et cetera? What do you think, folks? Give me your comments. Let me know what you think about gold, what you think about silver, what do you think about shiny metal in general, okay? And for those of you that jumped in a little bit late, I don't want you to miss out on that little QR code up there, because that QR code, and I'm going to talk a little bit about it here, could be a way that you could get my patterns and my research for less than $1 a week. What are you talking about, Tom? Well, I'm talking about something called Stock Cycles Trader. If you want to be part of Stock Cycles Trader for less than $1 a week, let me tell you what Stock Cycle Trader is. This is my stock research on stocks and ETFs using the money calendar. This comes with up to 5 90% stock patterns every week. We have a 7-part rules-based trading course that comes with this as well. It also comes with access to the members-only website, a library of special reports, monthly strategy sessions, and you can get all of this for $49 today with the promo code SCT49. All right. How do you do that? Click on the QR code that I have on the screen right now